So what's the only thing that can stop this now for Mr. Trump? He's being emboldened by the stock market. We saw what happened when it went down in Q1. He curtailed the tariffs by 90 days. So here's the lose-lose, I think, for risk assets. First of all, gold's priced in and got too expensive. It's starting to head lower. And just that scenario that unless the stock market goes down, why should Trump stop? Just blame it on the Democrats. It's their fault. And by the way, this keeps that lasts. I'm going to get those lower rates, and then I'll get it all resolved after the 61 days and let these people go. And by the way, by the time we get the midterms, the Democrats caused it, and we're much better off. This is their strategy scary. And the only thing that stops it, I think, right now is some kind of a miracle or the stock market going down.
It's crazy stuff. Yeah, I mean, I couldn't even imagine the government shut down for 61 days. I mean, at that point, I'd be shocked if, like, right now, the stock market, let's be fair, hasn't even flinched at this, right? It's just buy every little downtick in the market and push it to new highs. But 61 days of shutdown, yeah, I think that would impact it. And
the U.S. markets are entering a dangerous phase of delusion, where policy games, speculative euphoria, and political narratives mask deep structural cracks. Stocks continue to make new highs. Volatility sites at record lows, and investors are lulled into believing this cycle can defy gravity. Gold's parabolic surge toward $4,000, stretched to extremes unseen since 1981, is flashing the same warning signal it did before every primary market unwind. Meanwhile, tech stocks and AI-related equities are priced decades ahead of their earnings, and uranium and chip makers rally on promises, not production. Beneath the noise, the bond market quietly signals deflationary pressure, while the dollar's strength hides its own fragility. These are the conditions that precede reversals, not rallies. Gareth Soloway, a professional trader known for his technical precision, and MikeMcGlone, Bloomberg Intelligence's senior macro strategist, both see unsettling parallels to 2007 and 1999. When volatility inevitably reverts higher, the current melt-up could unravel quickly, taking overvalued risk assets down with it. Their message is clear: the time for caution is now, not after the correction begins. As cycles repeat, those ignoring the signs risk being caught on the wrong side of history. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
One thing about gold, you just take gold versus its 40, 50, 60-month moving average, and you have to go back to either 2011, the peak, or about there, or 1981 for last time it got stretched. So I am no longer bullish gold. I can't give investment advice, but the thing you learn as a trader and as a salesperson, when you get someone in a trade, you never hurt to take profits. You're just supposed to sell gold at $4,000 an ounce. It's overweight. I mean, when it had an issue like that in the significant 71 through the late 70s and 79, but that was pretty historic. And that high held for like decades. So I want to tilt over a little bit shorter term when I'm thinking. So gold, it's way overbought. It's leading everything. Now let's look at the ratio of S&P 500 divided by gold. It's down to 169 ounces. The peak was 260 ounces or so in 2021. It's heading lower, but it almost always goes down when volatility goes up. And this is 90-day volatility S&P 500. It's at 9%, just kind of recovered a little bit. It's the lowest since the bottom in 2020. So it's almost the lowest. And we could go back to almost 2018. And when that volatility goes up, and I didn't say if, volatility is always mean reverting, there's a good case to say that this gold S&P 500 ratio is going to drop down to the lows from 2020, which, by the way means if gold's overbought, which means S&P 500 has got to go down. I want to give you some facts, and I'm going to state this factually, and people can take it if they want. There's a good chance that the Bitcoin to gold ratio could drop in half. Right now it's 30. This has been one of my axes to grind for a couple of years when it's been lagging. It's 30. Our model, the Bloomberg model, which used to kind of be a leading indicator, is right now show fair values around 15 on the Bitcoin to gold ratio. And again, one thing that never happens when volatility gets this low, first of all, you have to have something expected, unusual for volatility to stay lower. When volatility picks up, the Bitcoin to gold ratio always goes down. Maybe it's different this time. So that's just a fact. Two more charts, and I want to show you a key thing. What's this most significant leading indicator, in my view, on the planet? Bitcoin gold. What leads Bitcoin? Strategy. Strategy's 200-day moving average. This has been my axe to grind, has rolled over. It bounced up to that 200-day moving average. It's starting to accelerate downward. At the same time, strategy goes down and signals a potential deflation from risk assets like stocks, Bitcoin, and cryptos. What's the key thing to go up? The one that's been beat up the most, that I've been wrong on for a couple of years, This is the bond future, just ready to break over. I remember I used to trade in that pit. I thought I knew that market. I've been wrong. So I'll end with this. One key thing, the big picture macro. I showed you this before. I just want to reiterate. You take total investment in treasuries. Just say your whole treasuries, you're earning 4 and change right now. That's from the front end all the way out. You got to go back to 1983 since a total value of that investment in terms of price is as low as it is versus gold. So gold's really expensive and treasuries are really low. At the same time, you got to go back to 1929, the last time we had that, my favorite, the Warren Buffett model, S&P 500, or stock market cap to GDP at 2.3 times. So that's why I come out with that. Sometimes you're just supposed to sell and say thank you and get out of the way.
That's a couple things those are amazing charts and really makes you think about potentially what we could see in the coming months into year end, even in 2026. Couple things that have been really I'm trying to do what Scott does and just turn my brain off and saying, hey, listen, this market's just going to rip higher. Right. But at the same time, I hear stuff that's being said out there and I'm just like, is this real life? Like, for instance, AMD went up 35% the other day and they basically got $100 billion revenue deal from OpenAI. Apparently OpenAI is the magic ticket to massive gains on stock price. But in response, they basically paid for this revenue themselves by giving OpenAI warrants to buy 160 million shares of AMD for a penny. And so we saw this with NVIDIA and OpenAI. It was like, okay, I'm going to give you this money, but then you have to buy this amount of chips back from me. And to me, it's like, that's a little concerning. Like, how does that even sustain itself in business? And then not only that, but, we ask ourselves, we see these uranium companies, these nuclear companies at all time, the vertical charts, right? Because, oh my goodness, all this power that we're going to need for these data centers. But if you find out there's literally 0 nuclear reactors being built right now in the US, yes, there's a bunch that are being scheduled, but it's going to take 5 to 7 years at minimum, maybe even 10. But these stocks are being priced based on earnings that they're going to see in 5 to 10 years. That's where the pricings are. And we're seeing that in AI stocks as well. I mean, AMD's up because their revenue, by the way, they won't even see any of this revenue until the end of 2026, so a full year, and it's going to be over the next 5 years. But their stock went up 35%. And so I guess logic be damned, throw it out of the window, I guess. But, this sounds like, to me, not 1999. I mean, To me, I don't know. You guys?
Well, Scott, I want you to respond. And to me, it's also that in 2007, the market peaked a little bit after the first Fed ease. I was on top of the trade. I remember getting stopped out a little bit and then getting way short. It was so hard to hold on. It was one of my best trading periods ever. It was just right after the Fed ease. You knew things were going bad. Now, the key thing is you have to remember that thing is about us technicians too. Sometimes markets give you signals and fundamentals will always justify very cheap or very expensive levels. It's just a part to trying to pick peaks. Not easy, but the times to really selling when they're yelling and buying when they're crying. But to me, this is very similar to after that first ease in 2007, and then the recession kicked in.
The U.S. economy is showing deep fractures beneath the illusion of growth. For many Americans, recession has been a lived reality for over 2 years, masked only by the relentless rise in asset prices. Stocks, cryptocurrencies, and speculative tech valuations have filled the void created by stagnant wages and persistent inflation. As the cost of living rises faster than incomes, households without investments are being drained by inflation that's quietly eroding purchasing power. The situation is worsening under the weight of political gridlock, with extended government shutdown risks threatening to remove billions in spending from the economy. Behind the scenes, policy maneuvers appear designed to pressure the Federal Reserve into deeper rate cuts, potentially sparking the next wave of speculative excess. Yet, as gold, silver, and Bitcoin fluctuate sharply and housing prices begin to roll over, the warning signs are unmistakable. The market's extreme complacency, reflected in record-low volatility, echoes the late stages of previous bubbles. When the tide turns, it won't just be an adjustment, it will be a reckoning across all risk assets. Let's get back to the interview.
I would argue that for the last 2+ years, over half the country is in a recession. It's just those that have investments are doing just fine because every year the stock market goes up, Bitcoin goes up, right? And so it's kind of filling the void, while anyone who doesn't have investments, inflation, I mean, think about it. If you don't have investments and you're getting minimum wage, I mean, you're getting crushed in this environment where inflation just keeps needling you up and up.
Well, I think you nailed it there. One thing that we all discussed, government shutdown. Okay, so anybody in that harm's way, first of all, They have to curtail spending. But even Anna Wong, our chief economist last week, had a complete flip. She said this shutdown is significantly recessionary. Okay, so she flipped on that. And also we have, okay, so think about what might be happening here. Trump says it's a good thing, but let's not underestimate human nature. People who work for governments aren't typically top 5 percentile, which most of us are lucky enough to be in terms of income. The point is, they are going to have to curtail spending at a time when it's really difficult. And a lot of them knows they might not get their jobs back. Trump has said that. And we have like people in the military. My son is not getting paid. So this significant amount of flow coming out of the economy is somewhat psychological. And then it also emboldens Mr. Trump to do what he's been wanting to do. And that is get the Fed to ease. So right now, the Fed's going to be cutting at the next 2 meetings. So check mark, he's accomplished that. Maybe get to curtail some of the excess spending in the government, short and curtail the spending of the government, or just pull back in the government a little bit. Check mark, he's getting that. So this is a lot of positive from him. And that the key thing, remember here, there's only one key force that might bring the market, bring these two diametrically opposed parties to the table to make an agreement. That's the stock market going down.
Yeah, you're right. And it did cross my mind about the shutdown is like, if your goal is to get the Fed to ease and push them to ease, then there's no real rush to open the government because you're trying to force another negative on the Fed to make sure that they are going to cut in. And I think Jerome Powell talked today, and we saw the minutes came out on Wednesday, I think, afternoon, and he basically said they're going to cut, but it's only a quarter basis point. Obviously, President Trump wants much, much more cutting, which probably will then happen next year when he kicks Powell out, I would think.
So what's the only thing that can stop this now for Mr. Trump? He's being emboldened by the stock market. We saw what happened when it went down in Q1. He curtailed the tariffs by 90 days. So here's the lose-lose, I think, for risk assets. First of all, gold's priced in and got too expensive. It's starting to head lower. And just that scenario that unless the stock market goes down, why should Trump stop? Just blame it on the Democrats. It's their fault. And by the way, this keeps that lasts. I'm going to get those lower rates. And then I'll get it all resolved after the 61 days and let these people go. And by the way, by the time we get to midterms, the Democrats caused it, and we're much better off. This is their strategy scary. And the only thing that stops it, I think, right now is some kind of a miracle or the stock market going down.
It's crazy stuff. Yeah, I mean, I couldn't even imagine the government shut down for 61 days. I mean, at that point, I'd be shocked if, like, right now, the stock market, let's be fair, hasn't even flinched at this, right? It's just buy every little downtick in the market and push it to new highs. But 61 days of shutdown, yeah, I think that would impact it. And let me show this chart on gold here. I think it's so interesting. So we talk about parallel channels. One of my favorite techniques to find tops and bottoms. Yeah. Look at the run we had. It goes right to the high end of the parallel, which matches the lows since January and the high that we had in April. We go up there, we pierce it, boom, to the downside. And then look at silver. This is really interesting because a lot of people, and by the way, a lot of people have said to me, like, I use trend lines, and very, very rarely I use log scale because I grew up with stocks versus crypto. And crypto, you got to use log scale because these things go up 100,000%, right, in a very short amount of time. Not so much with commodities especially. And look at this trend line here. This is one I actually shorted silver today. My first short on silver. I took the high from 1980. All I did was connect it to the high from 2011. So you have a slight upsloping or ascending trend line. And literally we came right to it and then dumped out. Amazing stuff. But again, I actually still think silver might, I think it's due for a pullback. I mean, obviously it's had an incredible run from basically August 20th. $37 all the way to 51. But you can't deny. I mean, I agree with you, Mike, at least in the short term, it's sell things until they correct, especially even gold and silver. And so I'm in that agreement with those two charts. Lastly, I just want to show Bitcoin here. So my level on Bitcoin, and this is just, again, classic TA. I'm not using anything crazy here. No logarithmic, just regular charts, but it just shows you this stuff works, is you have your 2017 high to your highest point here, which was your first high in 2021. Now, you did make a higher high later in 2021, but if you notice, that one did not touch the trend line. So I got to use the highest point where the trend line goes, and it literally gives us this high and then a pullback, this high, pullback, and then right here. Now, listen, we could break above this. I think we all agree. Listen, Bitcoin could consolidate and finally break out, but this is why Bitcoin is stalling out here on the chart. And I think this is the bigger question is, for me at least, is risk assets, right? If you tell me the stock market's going to finally have a 5-10% correction, Bitcoin should probably come down 15-20%. If we're just going to keep going up, then eventually Bitcoin's going to break out here.
But the key thing I get is Completely different from last year. It was the uncertainty of the presidency. And now it's the euphoria of nothing. Everything is so correlated. The sense I got is this is kind of what happens when you get to such extremes in market valuations. The U.S. stock market, the most expensive. I think Nassim might have mentioned, 73% of global market cap is just obnoxious. Actually, the macro panel, some of the guys pointed out that. And of course, I point out versus GDP. So the sense I get, I think, from the prudent people is, we're just looking for, is it going to keep going? The crypto guys were obviously so bullish. I enjoyed John Kadunas pointing that out, how still quite bullish. And they don't like when I say, well, what if the stock market goes down, and kind of brush me off for that. But the sense I get is this is pretty euphoric. That's what I think. The pendulum swung way too far to the Biden administration pushing back in free market capitalism. And it's amazing how we had this paradigm shift towards, with the Trump administration, completely endorsing speculative excesses. And this is how you get, in history books, you look back from this and say, that was kind of how things work out. They just don't last forever. And as you said, Scott, it's a question of when. My spidey sense is certainly saying last year I saw the end near for crypto's appreciation. Still stick with that, certainly relative to gold. And now this year, seeing this massive run up in things in gold, the ancient store of value that's lower volatility than anything. And anybody who's been overweight gold this year is crushing it. And they have much less demand on balance sheets because they're low volatility than anyone. This is just plain scary to me. I say sometimes it's great. The bell rings, and I think the bell's rung. And I got to risk being wrong, but I got to say what I think.
No, I agree. I'm with you. To me, it's the markets look bloated here. The question, and I keep on going back to 99 to 2000 is, even Greenspan, the irrational exuberance comment, and the market still rallied for 4 more years. And I think that's what most investors, I think, do realize, that it's unsustainable. But just like in crypto, there's this thinking of, don't worry, it's going to go higher, and then I'll just dump it on someone else. Until it actually happens, and then they get, we all get caught on the wrong side potentially. But it's a wild market. Just to see every asset except housing. I think that's the one kind of caveat. I didn't mention that until now, but housing in Florida, at least, and I'm in Florida right now, is collapsing fast.
What did it do in 2006? Housing led. Yep.
And so the question too is then, does that also contribute to maybe a potential recession? The only reason I say that is because, if you're used to your house going up 100K every year or 50K every year, you're feeling richer and richer, and all of a sudden it drops 100K, even though it's all figurative money, it's not real in your hands, you still are like a little bit more like, wait a minute, my net worth just dropped. I'm going to be a little bit more careful spending here. And so I think it's just something to pay attention to.
The reverse wealth effect is significant. And the potential for some reversion in that is the worst in history, the most extreme in history. And volatility in a 90-day basis in the stock market right now, the complacency is the most extreme in 5 years. Signals made, hit the bid. Sorry, you're supposed to just do that. And how about, we're close to, Garrett, I don't know how long you go, but we got a special event coming up with Market Mavericks, don't we?
The signs of exhaustion are flashing across global markets. From inflated stock valuations to speculative euphoria in AI and crypto, everything suggests we've reached the too good to be true phase of the cycle. Beneath the surface, the fundamentals are quietly eroding. Wage stagnation, rising credit delinquencies, and declining real estate values are now spreading through the system. What's holding it all up is confidence, not strength. And confidence, as history shows, can vanish overnight. The coming phase won't be about chasing gains. It will be about surviving volatility and preserving purchasing power in an environment of political division, fiscal decay, and monetary manipulation. We're entering a moment when narratives fade and reality reasserts itself. Investors who've relied on the illusion of endless liquidity will face the consequences of overextension. At the same time, those holding real assets, sound money, tangible value, and disciplined strategy will endure the storm. The illusion of stability is breaking, and those who prepare now will own tomorrow's opportunities. If you found this analysis insightful, please like, subscribe, and turn on the bell icon to stay updated as we continue tracking the shifts in gold, silver, and global markets. The next chapter of this cycle is already unfolding. Stay ahead of it.